In recent years, there's been a lot of interest and negative talk around fixed income or bonds as an asset class. In this video, we're going to touch on why that is, as well as look at the importance of it as an asset class and how this relates to retirees who are or maybe thinking about retirement. Fixed income refers to investments that pay a regular stream of income in the form of interest payments. They're issued at a par value and can trade at or below this amount. As you know, both the price of a bond and also the interest rate or coupon rate in advance, you can calculate the return from the outset. In this video, we're going to mostly focus on sovereign, high quality fixed income bonds. Right up until the onset of COVID and even after it, central banks followed extremely loose monetary policy to stimulate economic activity, which was characterized by ultra low interest rates and quantitative easing. This was because of benign inflation and low economic growth from the hangover of the 2008 banking crisis. Once COVID hit, which wrecked supply chains and caused a huge demand for certain goods, inflation started to soar. Be honest, who carried out a DIY project or went on loads of holidays once the lockdowns were lifted? Once the inflation is transitory argument was proven to be wrong and central banks realised it was much more stubborn than first thought, this led to regular and substantial interest rate hikes. Okay, so history lesson over. Fixed income securities, particularly those with longer durations or simply called long-term bonds, can be very sensitive to changes in interest rates. Bonds move conversely to interest rates, which is a concept that confused me at first. So think of it this way, when interest rates go up, the price of bonds go down and vice versa. You can see the impact of how the dramatic rise in interest rates caused a rout in bond markets and bond funds. This is particularly noticeable with longer term bonds as they are much more sensitive to interest rates. You can see how longer dated bonds lost almost 20% over the past few years, which has led many to question the preconceived notion that stocks risky, bonds safe, and having a low correlation to one another, which didn't transpire over the last few years of both stocks and bonds sold off together. This then begs the question, if bonds have performed so terribly, why own them now? So the first reason to still consider them in your portfolio is because they can offer defensive ballast to your portfolio when the proverbial hits the fan. Combining my love of history and finance as the boffin that I am, I've looked at some of the past bear markets and since 1972 and the returns of US stocks and US treasuries. Here you can see that in some of the biggest drawdowns the US stock market has ever seen, such as the banking crisis in 2008, when everybody thought the financial system was going to implode, the US stock market fell nearly 50% from 2007 to 2008. Yet, despite this, US treasuries were up 12% as investors sold risky assets and piled into what was perceived to be a safe haven asset class. Who knows if this trend will continue with other black swan or catastrophic events in the future. It would be remiss of me not to highlight that this phenomenon has not played out during the past year or two when both stock and bond markets have sold off simultaneously. Partly this is because of interest rates globally increasing dramatically to combat inflation. Here in the UK, for example, they went from 0.1 in 2020 to where are we today? 5.25 as of November 23. That's a percentage increase of, I don't even want to do the maths. If you remember the rule of thumb, interest rates up, bond prices down, this was never going to be conducive to bond investors, and we can see this with 10-year treasuries down over 20%. Along with the war in Ukraine and equity valuations at high levels, this has created a perfect storm for equity and bond investors. This is why the traditional 60-40 asset allocation has been one of its worst years. I was once asked by a client who was particularly aggressive investor and at the point of retiring, why not? Why don't I just invest all my money in equities as I'm comfortable with the volatility of an all equity portfolio? And over the longer term, historically at least, he said, and rightly so, equities have outperformed fixed income, and so he'd have more money. Now, this all sounds well and good in theory, but would you really be comfortable and act rationally if your drawdown pot of, let's call it 300,000, was cut in half or more, and this was meant to provide an income for you? The other issue with this strategy, however unlikely, is if we saw a Great Depression type period, such as 1928 through to 1931. Looking at the data for US stocks, which I admit going back that far is a bit patchy, stocks were absolutely hammered, as you can see on the screen now. If you were also taking an income from your pension, this could really affect the value of your retirement pot. This is known as the sequence of returns risk. The idea that the timing of investment returns matter, and to put this into context, if the stock market crashed on the eve of your retirement, say, just before you started to take an income from your pension funds, this would have a significant impact compared to someone who was, maybe like me, still working and in accumulation, who could just ride it out and wait until the funds recovered. Now, turning to the performance of US Treasuries over the same period, the return on Treasuries was actually positive. And so an allocation to Treasuries in that kind of scenario, that environment, would have really supported your portfolio. Now, I admit a Great Depression type event in which laissez-faire politics, that's really a fancy word for no intervention, and there was no central bank, which contrasts significantly to the world we live in now, in which central banks are much more interventionist and are more willing to act. As interest rates have risen, the yield on fixed income is a lot more attractive compared to what it was just a few years ago. The returns from fixed income can now offer a meaningful return and provide an income for investors looking for a yield from their portfolio. To calculate the expected return on a bond or bond fund is quite a complex calculation. However, an idiot's way of doing this is to calculate something called its yield to maturity. This is the return you would get if you held the bond until maturity. Now, don't worry, you don't have to get your calculator out. Most bond funds, which most of you, I imagine, will be invested in, will calculate this for you. For example, I've taken the yield to maturity from the Global Aggregate Bond Index, which tracks investment grade debt globally from 27 countries, made up of corporations and also countries. The yield to maturity on this index is approximately, give or take, 4.4%, which is not bad at all. If you're approaching retirement, watch this video, which looks at 3 of the biggest mistakes that I see with drawdown and what you can try and do to mitigate them.